Let's move our focus now to the fixed income space. We'll talk about the primary capital markets, and we're joined by Egie Akpata. He's the head of capital markets at UBA Capital. It's great to have you on the show with us today. Now, let's talk about the foreign debt that we're seeing being issued by banks. We have First Bank planning to sell $500 million Eurobond this year. And of course, Fidelity has successfully issued a $300 million 5-year Eurobond. So why are the banks suddenly more interested in raising funds from foreign sources and not local?
Yeah, good afternoon, Didi. Well, in terms of some of those bond issues, you have to bear in mind that there are different strategic reasons why a bank might be doing a foreign issue. One is in terms of getting hold of fixed rate dollar funding to match against some fixed rate transactions they have in Nigeria. The other, obviously, is in terms of size. There's the impression that the local market will struggle when you start getting to like $500 million for a private entity. The highest that any bank has done in Nigeria so far has been $35 billion, which is about half that. So that's also another reason why some banks are going offshore. But a number of Nigerian banks have made announcements that they're going to do Nigerian issuances also. Now, that Eurobond by Fidelity, that coupon rate of 6.8%, it matures in 2018, issue price of 99.48, and it's to yield 7%. So give us your thoughts on the pricing. Well, I mean, in terms of the pricing, I mean, it seems to be following a similar path to what the Access Bank issue was. The Access Bank issue was $350 million, this is $300 million. Having a small issue does create a bit of problem in terms of liquidity and getting accurate prices. But the most likely path the issue will take from here is to appreciate in price and drop in yield. Because given the B rating, it's a bit odd that it's yielding as high as 7% now. So it looks like a good buy. Now, Nigeria and some other African countries expected to sell debt instruments at about $7 billion this year. That's higher than the combined amount sold in the past 5 years. Why do you think we are seeing this increased foreign investor appetite for African debt? Well, I think, obviously, one thing that the foreign investors have figured out is that the risk in Africa is a lot less than they had thought in the past, or certainly a lot less than the risk in a number of European countries, which were seen as relatively safe in the past. So given the economic growth rate in Africa, the strong commodity markets internationally, and the reforming economies, the foreign investors are starting to get very interested in issues coming from these countries. So the past 5 years is probably not a very good predictor of where we are now, because a lot of those issues in the past were exploratory, they were very highly priced, and now the market is a bit more comfortable with the issuers. So I think that it's really a trend of the underlying economies in Africa, which the market is reflecting. However, some say that the political risk that exists in Africa is still being underappreciated. Do you feel that investors are getting risk-adjusted returns in the dollar bond space? Well, I mean, that's a good question. I mean, when you look at the rating of these instruments, there's a bit of a bias. I mean, you have a local currency, you're issuing a currency that is not yours, and automatically you do get a bit of a lower rating than you normally should. So you might wonder why a country like Nigeria, for instance, is classified as very far away from investment grade, given the strong oil market and the strong reserves. So sometimes these ratings do not totally match the reality of those countries or their probability of default. And so I think the reality is that the risk is probably not as high as people think. The risk is probably much less than the market is appreciating to date. However, average risk on African debt has fallen by 0.9% in the past 12 months to 4.4%. That's compared to 1.75% for 10-year treasuries. Still, the T-bill market is offering relatively more attractive yields. So are you starting to see a shift in foreign investor interest from the bond market to the T-bill space? Well, in terms of the T-bill space, I mean, it's shorter term, it's very liquid. And so you don't have some of the price shocks you can have with the bond space. So the T-bill market is obviously the preferred location for investors, particularly foreign investors. But again, there is some arbitrage that can be made by going a bit longer term and trading wisely. However, I mean, it will be interesting to know how low do you expect to see yields go, of course, with the increased hunger for investment in Nigeria? Well, I mean, we've seen a bounce off lows of about 10.5% a few weeks ago. We are hovering in the 11.5 range, so we're actually off the lows. But again, with inflation at 8.6%, there's a very significant positive real interest rate there. And if inflation remains in single digits, there's a very high probability that the federal government bond yields will trend down from here. But when you look at the short end with some T-bills as high as 12%, you have an inverted yield curve more or less, and it's very unlikely that the curve will invert more than it is now So you might have to see the short end of the curve come down first before long-term bond rates will start to trend down again.
Now, again, very quickly, what do you think needs to be done to stimulate more interest in state and corporate bonds? There seems to be a lot more interest in federal government bonds.
Well, in terms of state government bonds, there's a lot of interest. Last year was almost a record year, 157 billion compared to 157.5 in 2010. And there are quite a number of state government bonds in the works right now. So there is demand there. The process is a bit more rigorous than with the federal government, but we'll see over time more and more issues come to the market.